Right, let's find out more and cross over to Shanghai and join Alexander Friedman, Chief Investment Officer at UBS Wealth Management. Alexander, thank you very much indeed for joining us. That trade surplus out of China was, well, much higher than expected. What does that tell us about the Chinese economy?
Well, I think it's positive. I mean, there are really three big issues, as you alluded to, that we are watching, that the investment community is watching. It's how Europe unfolds, how the United States moves forward, and whether we're entering kind of a positive feedback loop, and critically whether China manages to not only engineer a soft landing, but really to come in above 8%. So the numbers that came in today are important.
All right. Okay, but China itself cannot really help to drag the rest of, let's say, Europe and the rest of the world back onto a more positive trajectory of growth, can it?
No, China can't do it alone. I mean, it's interesting. When you go back to 08, 09, the fiscal stimulus program that the Chinese engineered was massive. It was $600 billion or so, which I think was really quite much larger than the United States on a relative basis to their economy. It led, though, to significant inflation, as you know, and it led to a lot of indebtedness at the local level, as well as to kind of a construction kind of an overheated construction sector. So the Chinese are being very careful now to manage not to enter a similar kind of dynamic. So I don't think we can expect that any kind of easing going forward is going to drive the global economy the way it might have in 08, 09.
Alex, what do you think about the comments about the U.S. now? Do you think that the growth pattern that we have, or the news out there, can be sustained, the better news that we have, or do you think we slip back later in the year as, of course, we peter out from the last stimulus program?
Yeah, I mean, the United States is trending in a good direction. There are a number of, I think, dynamics, though, that you need to keep in mind. First, 2012 as a baseline looks to be more of the same from where we sit. Now, we're in a dynamic deleveraging cycle, and what I mean by that is we're in probably the middle of a 10-year deleveraging process, but it's dynamic, being that you've got a number of uncertain kind of overlays, both in Europe as well as at the geopolitical level, which can potentially undermine what is a fragile recovery in the United States. So I would characterize 2012 as more of the same for the overall story, positive trend in the United States, and fragility driven by geopolitics, with one positive and important supporting dynamic, which is that we've got leadership transitions in the United States, in China, in a number of significant countries in Western Europe. And during leadership transition periods, politicians have every incentive that is imaginable to essentially keep the ball on the court, not to deal with the really significant problems, which tends to keep the direction heading in the right way.
Now, you've got a call out there that this is not the time to be buying gold if you want to protect your assets. It's not a haven. You're saying the same thing for the Swiss franc. Says the gold rally over with.
Well, actually, I think gold could still increase. My point about gold is it's not a safe haven. And what I mean by that is if an asset can move 8% in a day, you can't think of it as a traditional safe haven. I think a lot of investors are confused about what gold really is. From our perspective, gold is protection against the debasement of currencies. And we have a lot of debasement of currencies. We have central banks in the United States and in Europe actively debasing currencies. So gold makes sense in that context. But you can't think of it as something that is delinked from the global dynamics. So when there's a liquidity-driven sell-off, you can expect to see gold potentially go down as well.
So is there a haven? That's the question here.
Yeah, there are not many havens left. I mean, one way to think about havens in the short term, at least if you watch kind of market dynamics, the U.S. Treasury is obviously, U.S. Treasuries are obviously still a haven. The dollar has a lot of support. The yen has some support. But longer term, the United States and Japan have tremendous structural debt problems. So when you think about havens in this environment, it's probably logical to actually start thinking about the biggest, best defensively positioned companies that have super strong balance sheets, that have a history of paying dividends even when times are tough, and that have highly diversified revenues across different geographies. Those companies, especially those that are AAA, they actually may be the new safe havens as we go forward.
Let's just also just look where you should be parking your money if you want some returns. Are you very much in the camp that you are defensive for the first part of this year at least?
Yeah, I mean, let me make 2 points. First, in the deleveraging world which we're in, with as many kind of bimodal outcome dynamics as there are, you want to reach for yield. And we can find yield in really 2 different categories. One is in high dividend equities, the kind I just referred to, and the other is in fixed income, specifically in kind of 2 categories, in good investment grade credit and also in high yield in the United States in particular, where there's a valuation that we think is pretty attractive. The market's pricing in a default rate that we think is unlikely given the amount of cash on U.S. corporates' balance sheets and some of the overall supporting characteristics in the U.S. economy.
Alex, thank you so much. Alexander Friedman there.